Pam Bondi fired. Does this actually impact your TSP? Pam Bondi was allegedly fired as Attorney General today, and I want to talk about this for a specific reason that has nothing to do with politics. Because here is a detail buried in this story that I think is genuinely worth your attention as a federal employee. Back in February, Bondi was testifying before the House Judiciary Committee. She was being grilled about the Department of Justice's handling of the Jeffrey Epstein files. It was a tense, combative hearing. And in the middle of it, she said something that stuck with me. She pivoted away from the Epstein questions and said, and I am close to quoting here, "The Dow is over 50,000 right now. The S&P is at almost 7,000. The NASDAQ is smashing records. Americans' retirement savings are booming. That is what we should be talking about." Now I want to be clear. I am not here to weigh in on the Epstein files or the politics of that hearing. That is not what this channel does. But that moment is relevant to your TSP for a very specific financial reason. Because the day Bondi said those words in sworn testimony, February 11th, 2026, was the same day the Dow hit its all-time high above 50,000. And since then, markets have slipped about 10% from that peak. They have not been back. There is actually a term for this in financial markets. It is called a contrary indicator. When non-financial officials start citing the stock market as evidence of success, it is sometimes a signal that markets are extended. The sentiment has become too universally positive, and the higher the enthusiasm, the closer you might be to a turning point. Now, I want to be very clear about something else. That is a bit of financial trivia. It is interesting. It is not a reason to change your TSP allocation. But today's firing of Bondi raises an adjacent question that is actually worth answering seriously. When political leadership changes at the cabinet level, does it actually matter for your TSP? And what kinds of political events do and do not move markets in ways that federal employees need to pay attention to? That is what we are going to break down today, calmly, specifically, with a real framework. Let's get into it. Let me give you the facts of what happened today and then explain why the financial angle here is more interesting than the political one. President Trump announced this morning that Pam Bondi is out as Attorney General. He announced it on Truth Social, praised her service, said she would be moving to a private sector role. Deputy Attorney General Todd Blanche, who was Trump's former personal defense attorney, is stepping in as acting Attorney General. The primary reasons cited in reporting from NBC, CNN, CBS, and others, Trump's frustration with how Bondi handled the Epstein files, and his broader dissatisfaction that she had not pursued enough of his perceived political opponents through the Justice Department. Her tenure lasted about 14 months. Now here is the market context that I think makes this story genuinely interesting for an investing audience. The Bondi Market Indicator, a piece of financial trivia worth knowing. On February 11th, 2026, Bondi was testifying before the House Judiciary Committee. She was under pressure from Democrats about the Epstein files, and in the middle of the questioning, she pivoted and pointed to the stock market, saying the Dow was above 50,000, the S&P was near 7,000, the NASDAQ was setting records, and that Americans' retirement savings were booming. That same day was the peak. The Dow hit its all-time high above 50,000 on February 10th and 11th. Since then, the major indices have fallen roughly 10% from those levels. The markets have not returned to those highs. And today, when Bondi was fired, the ranking Democrat on the House Judiciary Committee made a point of noting in his statement, "For the record, the Dow was under 50,000. Now, I want to be careful here about how I frame this. The market moving lower since February 11th is not because Bondi cited the Dow. Markets are lower primarily because of the ongoing conflict in the Middle East, rising oil prices, delayed Federal Reserve rate cut expectations, and a general risk-off environment. But the Bondi moment illustrates something that experienced investors recognize as a behavioral pattern. When officials, commentators, or media personalities who are not primarily financial analysts start enthusiastically citing market performance as evidence of broader policy success, it is sometimes a signal that sentiment has become too universally positive. The fear of missing out has replaced careful analysis, and that kind of unbridled optimism historically has sometimes appeared near market peaks. This is not a predictive tool. It is not a reason to change your TSP. It is a piece of market pattern recognition that is worth being aware of. Now let's get to the more important question. Does the firing of an attorney general actually matter for your TSP? How do markets process political events? Here's the most useful thing I can teach you about investing during a period of political volatility, and this applies whether we are talking about cabinet firings, congressional hearings, presidential speeches, or any other political event. Markets do not react to headlines, they react to implications. Specifically, markets are asking 4 questions every time a political event happens. Question 1, does this change monetary policy? Anything that affects Federal Reserve behavior, interest rate decisions, or the money supply is immediately significant to markets. The Fed is the single most powerful institution for asset prices. If a political event creates credible pressure on Fed independence, markets react sharply. Does the firing of Pam Bondi affect the Federal Reserve or interest rate policy? No. The Attorney General has no authority over monetary policy. This question has a clear answer. Question 2. Does this change fiscal policy, taxes, government spending, stimulus programs, deficit projections? These move markets because they directly affect corporate earnings, consumer spending, and the overall economic growth trajectory. Does the firing of the Attorney General change tax policy or government spending? No. The DOJ does not set fiscal policy. Again, a clear answer. Question 3. Does this create regulatory risk or benefit for specific industries? This one is more nuanced. The DOJ does play a role in antitrust enforcement, which can affect major mergers and acquisitions. It enforces laws that touch the financial sector, healthcare, technology, and other industries. A change in DOJ leadership and enforcement priorities can, over time, affect specific sectors. Does Bondi's firing create immediate regulatory risk or benefit for major S&P 500 sectors? The short-term answer is no. The incoming acting Attorney General Todd Blanche has said he will continue the same policy priorities. There is no announced change in enforcement posture. Over the medium term, if a permanent replacement is named and that person shifts antitrust or corporate enforcement priorities, specific sectors could be affected, but that is speculative and months away. Question 4. Does this signal broader institutional instability? This is the most subjective question and the one that requires the most careful thinking. Markets generally dislike institutional uncertainty. When governments appear unstable or when major institutions appear to be functioning in unpredictable ways, investors demand a risk premium. They price in uncertainty. Does the firing of a second cabinet member in roughly a month after the earlier removal of Homeland Security Secretary Kristi Noem signal broader government instability that markets should price? Here is the honest answer. Professional market participants are watching this pattern. They are not panicking over it, but they are noting it. A government that cycles through senior leadership frequently creates execution risk on policy priorities. It creates uncertainty about who the decision makers actually are, and it can, over time, affect investor confidence in policy predictability. That said, today's market reaction to Bondi's firing specifically, essentially zero direct impact. Financial analysts covering this today have explicitly noted her firing has virtually no impact on the markets. What actually is moving markets right now? Because here is something I want you to understand clearly. While the Bondi firing is getting significant news coverage today, the actual forces moving your TSP right now have nothing to do with who is running the Justice Department. Let me tell you what markets are actually processing this week. The Iran war and oil prices. The dominant market story of the last several weeks has been the ongoing conflict in the Middle East following U.S. and Israeli strikes on Iran. Oil prices surged more than 8% when markets opened after those strikes. Tanker traffic through the Strait of Hormuz dropped roughly 70%. Brent crude moved from the low 70s into the high 70s and is still elevated. Trump signaled earlier this week that the conflict is expected to last another 2 to 3 weeks at minimum. Markets sold off on that speech in what analysts are calling a classic sell the news reaction. Stocks are falling today as that overhang continues. That conflict and its effect on energy prices, inflation expectations, and Federal Reserve rate cut timelines is the primary driver of TSP volatility right now. The rate cut narrative. Before the Iran conflict escalated, markets were pricing in Federal Reserve rate cuts in 2026. Those cuts were expected to be fuel for equity markets, reducing borrowing costs and improving corporate earnings multiples. The oil shock has complicated that picture. Higher energy prices push inflation expectations higher, and the Fed cannot easily cut rates when inflation is elevated. So rate cut expectations have been pushed back, and markets have had to reprice accordingly. This is why the S&P 500 and Dow are now sitting roughly 10% below their February highs. Not because of any cabinet firing, because the macro environment shifted. The irony of the Bondi moment, and this is what makes the Bondi market story interesting as a teaching moment, not as a political one. She cited the stock market as the headline measure of success on February 11th, the exact day of the market peak. Since then, the macro environment shifted because of oil, because of geopolitical risk, because of rate cut uncertainty, and markets reflected that shift. The lesson for your TSP is not about Bondi. It is about what drove the reversal. And the answer is macro forces: energy, monetary policy, and global risk sentiment. Those are the forces worth tracking, not who holds any given cabinet position. Let me give you the direct, honest fund by fund read on whether Bondi's firing changes anything about how your TSP funds are positioned. For the C Fund, the C Fund tracks the S&P 500. Its performance right now is being driven by oil prices, rate cut expectations, the trajectory of the Iran conflict, and broad corporate earnings expectations. Bondi's firing has no direct impact on any of those drivers. The C Fund is down from its February peak because of the macro environment, not because of DOJ leadership. A change in who runs the Justice Department does not change the oil supply picture, the Fed's mandate, or corporate earnings. No allocation change warranted based on today's event. Regarding the S Fund, the S Fund tracks small and mid-cap U.S. companies. Small caps are more sensitive to domestic economic conditions and to tightening financial conditions caused by elevated oil prices and delayed rate cuts. Again, the forces moving the S Fund right now are macro, not political. The firing of an attorney general does not change the cost of fuel for small businesses, the debt service environment for smaller companies, or consumer spending patterns driven by energy costs. No allocation change warranted based on today's event. How about the I Fund? The I Fund tracks international developed markets, primarily Europe and Japan. These markets are currently facing the dual pressure of higher energy import costs and a strengthening U.S. dollar driven by the risk-off environment. DOJ leadership in the United States has no meaningful bearing on European or Japanese equity markets. The I Fund's current performance is driven by the energy shock and currency dynamics. No allocation change warranted based on today's event. The F Fund. The F Fund tracks U.S. investment-grade bonds. Bond market dynamics right now are being determined by the interplay between inflation fear and recession fear driven by the oil shock. Treasury yields are moving based on Fed rate expectations. The Attorney General has no authority over the Fed, no role in setting interest rates, and no impact on the inflation or recession dynamics driving bond markets. No allocation change warranted based on today's event. And the G Fund. The G Fund holds government securities. Its value does not change with political news. Full stop. No allocation change warranted based on today's event. Here is something I want to leave you with that will be useful for every political headline you encounter from this point forward, a framework for deciding whether a political event deserves a TSP response. I call it the policy transmission test. The question is simple. Does this event have a credible, near-term transmission mechanism to the factors that actually drive asset prices? The four factors that drive asset prices are monetary policy, fiscal policy, corporate earnings, and global risk sentiment. If a political event credibly affects one or more of those four things in the near term, it deserves your attention. If it does not, it is noise. Events that pass this test. A Federal Reserve chair being removed or credibly threatened with removal passes the test immediately. That goes directly to monetary policy independence and rate expectations. Markets would react sharply. A major, unexpected tax bill passing Congress passes the test. That is direct fiscal policy with immediate corporate earnings implications. An escalation or de-escalation in a military conflict that affects energy supply passes the test. We saw this with the Iran situation. Direct transmission to oil prices, to inflation expectations, to Fed policy, and to corporate costs. A sweeping regulatory overhaul targeting a major sector passes the test. New antitrust enforcement that blocks major mergers in tech or finance, for example, would affect specific industries in the C and S funds. Events that do not pass the test. Cabinet firings that do not change economic or regulatory policy direction. Leadership continuity at the DOJ under a deputy who has stated the same priorities means the policy transmission is minimal. Congressional hearings that produce political theater, but no legislative outcome. Lots of noise, no new law, no direct market impact. Presidential social media posts that express frustration, but announce no specific policy action. Markets have learned to distinguish signal from noise in this category. Polling numbers and approval ratings. These affect long-term political trajectory, but rarely have near-term transmission to asset prices unless they credibly change the legislative outlook for major economic legislation. The Bondi firing falls squarely in the second category. No change in monetary policy, no change in fiscal policy, no meaningful change in corporate earnings outlook, no escalation or de-escalation in the global risk environment. The policy transmission test gives a clear answer: noise. Now, do not mistake noise for meaningless. Over time, patterns of political instability can accumulate and affect investor confidence. That is worth watching. But it is a slow-moving variable that manifests over months or years, not something that should trigger a TSP move today. Let me bring this back to what actually matters for you. Your TSP is down roughly 10% from its February highs right now, and the reason for that drawdown is not cabinet shuffles or political hearings. It is the oil shock from the Middle East conflict, the resulting upward pressure on inflation expectations, and the delay of the Federal Reserve rate cuts that markets were counting on. Those are the forces worth watching. Those are the forces that will tell you when the environment is shifting back to something more supportive of equity markets. What should you be watching? Oil price direction, tanker traffic through the Strait of Hormuz, any signal of diplomatic progress in the Iran conflict, and Federal Reserve communications about when rate cuts might resume. A cabinet firing? Not on that list. Not because politics does not matter, it does, but because this specific event does not have a near-term transmission mechanism to the drivers of your TSP. The biggest risk you face right now as a federal employee is not who is running the DOJ. It is the behavioral risk of reacting to every political headline as if it requires a TSP response, because that kind of constant reactive trading with 2 IFTs a month and the emotional cost of every news cycle is one of the most reliable ways to underperform your own long-term plan. Discipline looks like this. You know what factors actually drive your TSP. You watch those factors, you ignore the rest, and you let your long-term allocation and consistent contributions do the work that compound growth is designed to do. Pam Bondi being fired today is a big political story. It is not a TSP story, and knowing the difference is exactly the kind of financial clarity that protects your retirement. Not every major headline changes your financial future, but understanding which ones do and which ones are noise, that is where the real investing advantage lives. Use the policy transmission test every time a political headline hits. Does this event have a credible near-term path to monetary policy, fiscal policy, corporate earnings, or global risk sentiment? If yes, pay attention. If no, file it as interesting and move on. Today's answer was interesting, not actionable. The events actually moving your TSP right now are the oil situation, the rate cut timeline, and the trajectory of the Middle East conflict. I have covered all of those in recent videos and will keep covering them as the situation develops. If this breakdown was useful, subscribe to Rod, the Art of Finance. This is where federal employees come to get a calm, clear, financially rigorous take on what is actually happening in markets and what it actually means for their retirement. I will see you in the next one.